And here we go. I'm going to madly admit, and Brenda will chat with us while we do. So Brenda, I'm going to say it wrong. Vingiello, did I get that right?
Yes, you did. Vingiello.
I have worked with a colleague of Brenda, Sarah Craven, at Sandhill Advisors for many years, and actually Jane Williams, who founded it, for many, many years. And Brenda's with Sandhill Advisors. She's the Chief Investment Officer. And I had the privilege of watching Brenda present at one of my network groups and said, Brenda, please come talk to the group here. So I'm thrilled to have her. She, Brenda gets around. She's on CNBC sometimes. I have watched you. I feel like I'm a little brush with fame there now. But anyway, it's lovely to have you. Thank you. And tell us what you have and launch away.
Great. Well, thank you, Nikki. And thank you all for having me. So I'm going to walk through a presentation where, I'm a big fan of data because I think when you look at data, oftentimes it tells a little bit of a different story, especially versus what the media might be telling. And the media loves a negative story. That's what sells. That's what gets emotions moving. But just to start off here, if we think about what has happened this year in financial markets, and this is a little dated, it says of June 17th, but we're actually right back to almost where we were in June 17th. We had a little reprieve over the summer, the market rallying, but we're right back to where we were in June. This is the second worst start to a year in history. So not only for the stock market, but also it's been terrible for bonds as interest rates have risen. So it's created a pretty ugly environment. But it does come after 3 incredible years that we had in 19, 20, 21, where market returns were really phenomenal and outsized in all of those years. But a lot of people have asked, what is the market telling us? Are we in a recession? And if we look at what happened in the first 2 quarters of this year, we had 2 quarters of negative GDP. So that's a back of the envelope definition of a recession. But if we look at what a real definition of a recession is, it is a significant decline in economic activity that's spread across the economy that lasts more than a few months. It's visible in GDP, real income, employment, industrial production, and retail sales. So if we look through some of these items, the first one is the employment market. This is looking at the total number of employed people. We've completely regained everything that was lost in the pandemic. There's now more people employed than there were pre-pandemic. So there's really no sign, and we have over 11 million jobs that are unfilled. So there are really no signs in the employment market that there's a recession happening. If we look at real disposable incomes, this means income taking inflation into consideration. This is an area where we're starting to see some weakness, where there has been wage growth, but it hasn't been keeping up with the overall pace of inflation. So something to watch. But if we look at where we're at today, we're actually still slightly above where we were pre-pandemic, but something to keep an eye on. Industrial production has also been really strong. No sign of a recession here at all. Things are incredibly strong in this part of the economy as well. Retail sales also, this is looking at in millions of dollars. And when I look at a chart like this, I'm just kind of in awe at all the spending that happened over the last few years. It's been really phenomenal and has continued. Yeah, we have not seen a lot of weakening here. And I think a lot of it's because if we look at the health of the consumer and household net worth, this also is looking at just total gain and net worth. We've seen it come down a little bit here, and that's because the market's done what it's done. We have a 20% correction in the equity market, bonds as well. Real estate prices are starting to come down in some parts of the country. That's all contributing to this. But nevertheless, we just saw this enormous increase in dollars and household net worth in a very, very short period of time.
Brenda, can I just interject, and maybe you're going to get there, and forgive me if you are, but how much of this is because of the amount of money that the Feds have just pumped into the economy?
That has a lot to do with it. So the Fed did pump a lot of money into the economy, and even though it may not have directly hit some people's bank account, it kind of indirectly did through looking at all the PPP loans that went out that were forgiven, that sort of activity that helped just strengthen overall health of the economy or the business community. And this really kind of inadvertently, kind of contributed to this in some ways, especially with, seeing what happened in the equity market during this time. So that has certainly contributed. But the other thing that happened is that consumers, by and large, have been much more disciplined this time around than they have been in the past. And I have, if you look at debt, for example, on consumers' balance sheets, it's pretty low as a percentage of disposable income versus where it has been at other periods in time. And so during the pandemic, people saved a lot also. The savings rate really increased pretty significantly. And that's one of the reasons I think why consumer spending has been able to continue, even though, as we saw on the earlier chart, people's incomes growth is really not keeping up necessarily with inflation at this point, but people saved so much during the pandemic and their balance sheets are still pretty healthy that they have been able to spend even in the face of higher prices, even though no one's happy about it. Consumer confidence has been terrible. No one's happy, but everybody's still been spending for the most part. Also, if we look at, what's coming down the pike here, and we look at how banks are capitalized this time around. People point to the great financial crisis and say, gosh, look at what's happening. Could there be a repeat? And when we look at the banking sector, there's no chance there's going to be a repeat. Banks are so much healthier than they were heading into the financial crisis for sure, but they've just increased so much of their reserves that they are just incredibly healthy at this point.
Is that because they were required to through all that stress testing, or is that because they realized that was a good idea?
It's a little bit of both. But coming out of the financial crisis, a lot of banks were forced to walk away from a lot of risky business, and so or business that was good business but that had a higher risk to it. So they're really not even in business anymore. And on top of that, they were forced to increase their overall capital. And so it's been legislation that's been, but also financial discipline at the banks. And then if we look at California in particular, because I know you're all very interested in what's happening in your local markets and in California, the unemployment rate in California is really low. So in our view, we look at, what causes a recession typically. Usually it's a slowdown in consumption. Consumption drives more than 2/3 of GDP. And in our view, people stop consuming when they're either worried about losing their job or they do lose their job, and now at this point in time, we're so far from that, given the strength of the job market. We could see it start to weaken. We think we will likely see it start to weaken, especially as we look at some areas of the economy, like housing, that really is dealing with this shock, that's come from mortgage rates increasing so significantly in such a very, very short period of time. But that being said, when you look at something like the housing market, interest rates are not really that far outside of the historical norm. It's just that we were so far below the historical norm for the last few years that it's quite shocking to have mortgage rates, double in a less than a year's time. But when we look at the drivers of the housing market, I didn't include a chart because there wasn't anything good for me to use, but the San Francisco Federal Reserve just came out with a paper this week talking about how their study suggests that the work from home movement was really responsible for a lot of the increase in home prices. And so that's not going away. More people are still working from home. We have a millennial generation that's really in the prime home buying years, in household formation years of their 30s, that's really driving a lot of this. And then I think we just need to see in some markets that, home prices probably need to normalize a little bit, given the phenomenal increase that they saw, in order to make affordability more palatable for people. But I don't think that the fact that mortgage rates are up as much as they are suggests that we're going to have a repeat of what we saw during the financial crisis. We're in quite a different environment than we were then.
That was caused by our industry, by my industry, right? Caused by lending.
Caused by lending, right? And there also wasn't a great demographic trend at that point. It was my small generation of Gen X that was in the home buying years, but it's a tiny generation. Millennial generation is enormous. And so we shouldn't take that for granted. And also the work from home trend, I think, is in many, especially in the state of California and of the Bay Area, I think is here to stay. People are not going back to work and in many cases to the office. And so that's important. And I think people look at their home differently with that sort of lens.
Mm-hmm. Yeah, that chart gives me, makes me hyperventilate a little bit.
Sorry, apologies for that. I think I should have made it a little bit longer and then you
very personal, that one.
It would have been quite so shocking. If we think about financial markets, and I would say, you know, in the Bay Area, financial markets are important too, because so much of people's compensation has historically come from stock. But if we look at what's happened with bond yields, you know, they have increased significantly. It shows where treasury yields were at the beginning of this year versus where they were just recently. So they have risen significantly. We are of the view that they're probably getting close to peak. I think definitely by the end of this year, we'll probably be close to peak. And because we are seeing signs that the economy is starting to slow, we're seeing signs that inflation is starting to come down, although it hasn't shown up as much in the major numbers just yet, but I think it's only a matter of time before we get there. But we think about asset classes and investing in bonds, you know, right now is suddenly it's a much more interesting time to think about investing in bonds. Certainly more interesting than it was a year ago when yields were close to zero everywhere.
It's actually kind of nice to have something that you can guarantee a rate of return on.
That's right.
Just going back to that slide, just for everyone, I'm sure you all know, but the mortgage market follows this 10-year bond. So we're not looking at, we used to look at a 30-year, but we're looking at the 10-year long bond, or that's the one that we follow for interest rates. So, you know, people think it's the Fed funds rate, but it really is this. This is the thing that drives my rates up, down, up, down, up, down every day.
Yeah. And I think the other dynamic to take into consideration is even if the market is always looking forward. So when you think about what is the market really telling you with the 10-year bond, it's telling you where it thinks yields are going to be 10 years from now. So we could have a dynamic where the Fed continues to raise short-term interest rates, but where the 10-year bond doesn't really move very much. Or even if the bond market starts becoming convinced that we're going to enter a recession, you could actually see longer-term interest rates start to come down a little bit, even as short-term interest rates are rising.
They like the fact, right? They like the fact that the Fed is working on it. They probably wish they'd have done it a bit sooner, but the long-term market likes the fact that they're getting a handle on it somewhat.
That's right. And, you know, I think in our view too, I think even if short-term interest rates, as I said, continue to rise, you could see long-term rates stay pretty stable or even start to come down if the bond market becomes convinced that the Fed is going to have to start stimulating the economy because they've overdone it by raising interest rates. You know, that was definitely a view during the summer. Jay Powell has come out and done his best to try to extinguish that view and say that he's focusing on raising rates and keeping them higher for longer. But I think it remains to be seen, you know, whether that strategy ends up ultimately working or if a year from now the Fed is actually starting to talk about potentially lowering interest rates.
One quick note from my side here is with many of our 30-year fixed mortgage rates, we're seeing most of them pricing not at par, which what that means is that they're encouraging you to pay points to get a certain rate. And that tells us that the investors are not thinking that they are going to keep this on a long time. So they want to make the yield up front. They think that you'll probably refinance. So when we see less par or good buy down options, that tells us that the market is also thinking, hey, next year we're going to have people who got their houses in the fall of this year refinancing. So that's both good news, hopefully.
We think about the equity market. You know, this chart shows the forward price to earnings ratio of the S&P 500. And for the better part of the last few years, it has been very extended and was more than one standard deviation above the norm. But we've absolutely seen that come down pretty significantly. What's happened this year in equity markets is earnings estimates haven't changed very much. It's just all been this valuation adjustment. And we've seen that earnings have actually remained fairly healthy, which is a good thing in our mind. It kind of substantiates this view that I shared earlier that, you know, the underlying health of the economy is still pretty good.
Which is
And so,
very different from that dot-com boom where we had money being made or valuations on things that weren't really real. It was just an idea, right?
that's right. And, to be fair, we had a little bit of that happening last year, for example, where there were a lot of very early stage companies that were going public. But thankfully, when you look at the grand scheme of things, they represent a very, very small part of the investable market. But it was that kind of activity that was a little red flag saying, wow, okay, this is a company that should have been private for another 5 years or more before going public. And
Profit might have been a good idea before we
yeah,
revenue, maybe even revenue.
right. But I think the good thing too is even towards the end of last year, you couldn't really see it on the surface of the stock market, but underneath there was a lot happening where a lot of those early stage, fast growth, very high valuation companies were already starting to experience a correction. And now they have absolutely experienced a significant correction. So we look at, is there a lot of froth in the equity market? It doesn't look that way at all. In fact, it looks like there's a lot of very decent, very healthy companies that are trading at pretty low and reasonable valuations now. Also, if we look at, what drives the stock market in the US, especially share repurchases are huge and they really help smooth things out. And so this year, there's a lot of companies where suddenly the dynamic changed where in 2021, the theme was growth at any cost. Doesn't matter, as long as you're growing, that's good, and you can, achieve a certain valuation multiple, certainly the case in 2020, 21. But now things have changed where the market suddenly is saying, profitability rules over all else. You need to focus on profitability, cash flow generation. So what are companies doing? Well, they have announced more share buybacks because they're using some of that excess cash to buy back their shares. So that ultimately usually supports equity market at a certain level. And for companies that are able to buy back a lot of shares when their stock price is really depressed, it is beneficial to them, especially if the stock price recovers. And then that was certainly a valuable thing to have done with their excess.
How much of that is to show confidence in their, like to their employees or to their shareholders? Does that come into that?
It does. I think even more so is, for example, the CEO stepping up and buying more shares personally. So I think that, usually will go a long way in terms of giving confidence to employees that there's long-term value in the stock, that they should still be happy to be receiving stock as part of their compensation, not sad that they're getting stock that they're seeing, fluctuate in value. So we absolutely have seen that corporate management teams have also stepped up to buy back their own stock. That was not the case, incidentally, over the last few years, where there was a lot of insider selling that was happening, certainly at really extended valuations, but now it's certain that dynamic has changed. So the other piece of this puzzle, and very important piece, is inflation and what is happening with inflation. If we look at what's happened to a lot of commodity prices, this just shows oil, gas, wheat, lumber, to name a few. We have seen that prices over the last year have really started to come down, in some cases quite meaningfully. But we haven't seen this really show up in the cost of goods, for example, where along the way, I think input costs are going down for companies in many cases, but that is not being passed along yet to the consumer. So I think it's only a matter of time before that starts to happen. I think we will likely need to start to see demand soften a little bit. And then, someone will blink and start lowering prices, and then it becomes a little bit of a cascading effect, especially in some industries that are, more competitive. But we've seen also in these surveys that regional Federal Reserve offices do surveys of their local regions and look at businesses and ask what prices they're paid and received. And we're starting to see that that's absolutely coming down. So we know it's there. It hasn't shown up yet as meaningfully as we would like to see it. But I think this is a very important part of what's going to drive the Fed going forward.
Yeah, I mean, that lumber number was shocking, how That's so relevant to our industry, that bottom right corner there, to be up above 1,400 per thousand board feet, down to, I mean, that's huge.
Yeah, it's enormous. Yes, so we have seen a lot of corrections here, and again, when we look at what are some of the lingering effects of inflation, well, I think the other thing I didn't mention is we're not seeing it show up as meaningfully as I think we will start to see, but like Zillow, for example, has a measure of rent, and it's showing that rent is starting to soften across the country. That's a major input to CPI. Is a cost of it's a very weird way that it's measured. So the cost of rent, or what they call owner's equivalent rent, where they basically survey homeowners and ask them, what do you think you could rent your house for? And then it tends to lag because people overestimate or they underestimate as prices are going up, and they overestimate as prices might be coming down.
I have a feeling our audience gets that in terms
yes,
of
I'm sure you all intimately know that people tend to do that. So that's a lagging piece, but I think it will start to present itself a little bit more meaningfully as time goes on, especially in some markets where we just saw prices increase significantly and where affordability is now much more of an issue, and we're starting to see prices come down as a result.
And that, so the CPI Consumer Price Index, which is, what we see, producer prices, the PPI that we see come out just for everyone. How far lagging from these, from what we're seeing, these lovely charts that you've shown here, is that CPI? Is it like 2 months? Is it, like how? Because when those numbers come out, I hide under my desk. That's the, oh my goodness, is the sky falling in terms of the plants.
Yeah, I think, when we look at some inputs like gasoline, for example, there's a direct reflection in the CPI from gas prices. But all these other commodities that might be, or, shipping costs also have come down a lot. So there's a lot of input costs that go into, for example, a manufactured good, but we're not seeing necessarily the goods prices starting to come down. But I do think, and to me that spells, well, okay, I was thinking, well, from a corporate profitability standpoint, it's not so bad if we're thinking about Wall Street and corporate earnings, because someone's earning a higher margin because they're not passing along lower input costs. But I do think it's only a matter of time before that does present itself in the end product or service that's being offered. Obviously on the wage side, that's also problematic because the employment market has just been so strong, and there are so many open and unfilled positions that's putting a lot of upward pressure on wages. But I think as the economy softens a little bit, we will see the job market start to soften. And it's not, nobody likes to think about that, but I think it's a necessary, it's a necessary thing in order to, again, alleviate some of this wage pressure that's happening within the job market. And a perfect scenario would be you just eliminate a lot of those 11 million positions that aren't filled, and then a lot of people don't actually lose their job. I don't think it's going to work out quite that way. But I do think we will see certain areas of the economy where things are softer, especially areas that really benefited from the pandemic. If you think about using Amazon as an example, Amazon really had to flex up just to try to have some kind of consumer experience that wasn't a complete disappointment during the throes of the pandemic. And now they're finding that the things are normalizing a little bit. And so they found that they've actually overexpanded, their some parts of their business, and they're having to right size those. So I think it's kind of a tale of that sort of thing happening in areas of the economy that really benefited from the pandemic. And those that didn't are still seeing that they need employees and are trying to still ramp up and scramble. And like the travel industry is a great example of that. So we're seeing, very different trends in different parts of the economy, but together they're still spelling a picture of relative strength. But I think we will start to see perhaps more meaningfully some areas of the economy where there are job losses that happen that serve to.
We're certainly seeing that in my industry, because we are one that did benefit from rates being at 2.5%. So
yeah, absolutely,
huge, layoff waves in the mortgage world.
Right. So that does it for my presentation, but I'm happy to answer any other lingering questions that people might have.
I thank you so much. So of course we're all going to say, what's that for next year? And what, given that you're all of your clients are our clients, they're local people high net worth people. What are you seeing in terms of the mood of that? Are they seeing that this is an opportunity maybe to jump in and buy that house or move up? Or are you seeing them saying, I'm just taking a pause? And what are you seeing in terms of the mood?
On the real estate side, well, I'll say that over the last 2 years, we've had an exponential number of people buying and selling homes. It has been really significant. We have a lot of clients that are in the midst of the home remodel, and it's not terribly good timing for them if they were relying on their financial assets to help fund some of that. But we are seeing, in general, that clients who've been invested for at least 5 years' time have really benefited from an incredibly strong market, equity and bond market in 2019, 2020, and 21. Those were huge years of over earning, I would say, relative to historical averages. So this year is obviously a disappointment, especially because we've had negative returns in stocks and bonds. So there hasn't really been anywhere to hide. Mm-hmm. But I would say that in an inflationary environment, people are also looking at real assets. And so I think they're looking at their real estate and saying, okay, yeah, the price of my home might come down. Is it going to go down, 30% or 25% or something like the stock market? Probably not. And of course, we all think about our homes differently. We don't include them personally in our overall asset allocation for our clients. We ask people to think about their primary residence a little bit differently because it serves so many purposes and not just an investment purpose.
After all, a place to live, yes.
Yeah, but I think, the major difference I think we're seeing now is that we had a lot of clients who were using their financial portfolio and taking on margin loans in order to buy properties for cash. And now that asset prices have depressed, it just doesn't afford as much of a margin loan, or it might be a scarier prospect to think about taking out a margin loan when we have more volatility. So that I think is probably going to hampering some of that activity for now. Although, so many clients are in different positions, and a margin loan is still pretty attractive, at least the rates that we can get for clients versus other forms of.
What are those sitting at right now?
I'm sorry?
What are the margin loan rates sitting at right now?
I think it's not too far from the Fed funds rate. So it does adjust with the Fed funds rate. So it has gone up a little bit, but it's not a 6% mortgage, or it's not a short-term financing solution that might be a kind of a double-digit type of rate. So it's especially useful, I think, for clients who may not have a traditional type of job or income source, but they do have a lot of financial assets that they can use to leverage at times for a short-term opportunity. So people are still looking to that to do it, but I'd say given the decline that we've seen in financial assets, they might not have quite as much flexibility as they did a year ago.
It's not for the faint of heart, that one. You've got to be on the stomach and move.
That's right.
Yeah, thank you. Okay. There's a couple questions. Let's see. Lucy, I think we answered the cost of labor. I think right after you asked that, Brenda went into that. So if you have any other questions, ping in there, feel free, or unmute. And Lavinda asked, how long is the lag between the CPI announcements, and does it reflect last month or last quarter? I know we touched on that, but I don't think we gave it specific.
Yeah, it's the prior month. So it is lagged. So that's it's a great way to think about it too, is, we're looking at old data. And so that, in our view, is why we think things are going to improve on the inflationary side, because we're seeing all these other data points that suggest that inflation should be coming down more than it has in the official numbers. Also, one thing to keep in mind is that the Federal Reserve focuses more on PCE, which is a different measure of inflation, rather than CPI. The media loves CPI. It is higher now than PCE, but the important thing in my mind, the difference is that PCE, that rent and category is not as big. And I think that's going to be a stickier piece, perhaps, especially if affordability is low in some areas and more people are forced to rent. We might not see rents come down, true rents come down as much as we would otherwise, but that piece is smaller within PCE. So I think PCE is the more accurate measure to watch if you're really trying to gauge the Fed's reaction to inflation, but it is lagged number. And so I think if we look at all these other ancillary measures, it tells a little bit of a different story that things should be starting to improve as we look forward.
We like that story. We're going to hang on that. Right. In terms of mortgage rates, do you have what is your crystal ball looking like on that? I mean, it seems that we're going to get another, 1.5 or 1.25 raise on the short term before the end of the year, which again, as we said before, should be good for the long term in the end.
Right.
But what are you seeing? Do you have any kind of prediction on mortgages? I mean, would you buy now, or what are you telling your clients?
I think a lot of our clients, they get it and say, I understand I might have to deal with a higher mortgage than I want for a year or two, but then I'll probably be able to refinance and rates will probably be lower. And we don't know how things are going to end in this current economic cycle that we're in. But I will say, that if you look at all those charts I went through, we basically experienced all the improvement in we've experienced an economic cycle that took a decade last time, happened in 2 years this time, in terms of how bad things got and how long it took to improve. It was almost instantaneous that things have improved. And now we have a Federal Reserve and globally have central banks that are raising rates at a very fast pace. So we could find that we ultimately experience a recession. And if we do, our view is that knowing what we know today, it's likely to be pretty mild because we don't have a lot of these excesses in the economy that we've had during other cycles that have caused a more prolonged recession. But if that is the case, then the Fed now has more tools in its tool chest to be able to lower interest rates and help stimulate the economy. During the last economic cycle we were in, that was a huge concern, is that we had this long cycle, but it was categorized by very slow economic growth. And the Fed kind of tiptoed its way into raising interest rates, and they would back off every time, the market threw a little fit, and they would stop, pause. That's not what's happening now. We're full steam ahead. But I think when we think about, well, what could the Fed do to stimulate the economy? Well, they have a long way to go now to lower rates if they needed to do that, to try to stimulate the economy.
Yeah, they were stuck with nothing when the Fed funds rate was at zero. They were stuck. Right. I mean, all they could do was put money in the economy, right?
That's right. All they could do is continue buying more and more bonds and building up the size of their balance sheet, which they're now running off in addition to raising interest rates. So, our view is that interest rates rising as fast as they have is shocking, not only for areas like the housing market, but other parts of the economy too. But there's also a lagged effect between when the Fed raises rates and when we actually start to see it impacting the economy. So we may not really know even fully, what the impact of the rate increases that have already been done are for another 6 months' time, when we really see the impact to the overall economy. So we may find that the Fed doesn't need to do everything they've said they're going to do. I think they're in this situation where over the summer, the bond market was very convinced that the Fed was going to actually start lowering interest rates by next year. And so they've come out with very tough talk, very hawkish talk to convince markets that that's not in the plan. And in many ways, they need to do that because they need to control long-term inflation expectations. The last thing they want to have happen is for everyone to start tacking on a CPI adjustment to everything. And suddenly it just becomes a much more systemic problem that has to be dealt with. And you ultimately need a more severe economic slowdown to solve a problem like that.
Yeah, absolutely. We had a question in here about printing money. You basically just addressed that, which is, when we hear that conversation of what does printing money mean, it's they're buying bonds. So it just means they're putting money into the money supply, right? And is that M2? Am I right there?
That's right. Yes, putting money into the money supply. The one thing that's happened too that's hasn't been very talked about, but but anybody who paid taxes last year can probably appreciate this. But tax receipts have been so high because as things have inflated, tax receipts have inflated along with that, as asset values appreciated. And so the government has actually paid off a lot of the debt that was incurred as part of the stimulus related to the overall pandemic. And so if we look at where debt is relative to GDP, we're kind of right back where we were pre-pandemic, which is almost mind-boggling, but true. And the Federal Reserve, though, doing what they're doing now by letting the balance sheet naturally run off, meaning they're letting those bonds they bought mature and they're not replacing them. And so in that sense, they're reducing the amount of money supply, which is should cause the economy to slow.
Mm-hmm.
And that's their way of trying to control inflation.
Those are the tools they have, because they don't.
That's right. It's a very blunt instrument.
Right.
So it's not a very precise way to go about things. It's either on or off. And so they're definitely doing what they can to try to slow the economy enough to combat the inflation problem.
Yeah.
Mm-hmm.
Somebody had asked me a question earlier before we started about they'd seen a statistic that 3 to 3.5% of the current inflation is because of the situation with Ukraine. Do you have any color on that?
It's hard to measure. I would say, we've actually seen in some cases, at least in our country, certainly not around the world, but in our country, oil and gas prices come back down to where they were before the war broke out. So in that sense, I don't think we're seeing the inflationary pressure that we were seeing, 4 or 5 months ago, for example.
Mm-hmm.
But it's hard to measure exactly how many supply chain problems are being caused by the war in Ukraine. And also, when you think about multinational companies and how their businesses are impacted, one thing that's happening right now is the dollar is incredibly strong. It's great if you want to take a vacation to Europe, but otherwise it's really not very good for our economy. It makes all of our goods and services more expensive for everyone in around the world. And so the fact that the dollar is as strong as it is a bit of a problem, especially for multinational companies that are trying to do business.
Right. Personally, it's cheaper for me to go see mom, so I'm really happy.
Yes.
It's cheaper to never be. And then Peter had asked, I think you may have covered this too, would you expect to see rates lower quickly if inflation starts to come down? Quickly is just such a good...
Yeah, I think one thing that Chair Powell has hinted at, and I think this is because, so we subscribe to a lot of macroeconomic research, independent research. And one thing that a lot of those firms have been saying is the Fed is going to repeat some of the mistakes that have been made previously. And Volcker made the mistake of lowering interest rates too quickly. And then inflation came roaring back. And then it took an even deeper economic slowdown to fix it. And so Chair Powell has referenced that and said, that's why they're saying we're planning to keep rates higher for longer, because we really want to make sure the inflation problem is contained. We don't want to lower rates too early and then have an even bigger problem on our hands. So I think for right now, I would say, they're planning to raise rates and try to maintain them in this restrictive territory as long as they can. It's unclear how much economic pain they would be willing to see happen in the economy if that is what happened. Mm-hmm. We're starting from an area of a lot of strength in many areas. So I think we could see some softening without, again, seeing a real significant recession, for example. But for now, I would say I wouldn't expect that if we saw an inkling of economic softness that the Fed would start lowering rates.
But having said that, the bond market looks forward, right? So the bond market that we follow, our mortgage rates, will probably go, oh, that's good news coming down the pike. And they will probably like the fact that the Fed doesn't just overcorrect again. So from a mortgage perspective, it may be that as soon as we see inflation get a track, we're going to go, okay, we can settle and not. Maybe I'm wishful thinking.
That's absolutely right. Yeah. And that's absolutely what we could see is that those longer term interest rates might start coming down, in anticipation of the Fed eventually starting to lower interest rates. So you may see that mortgage rates do start to tick down a little bit in that sort of environment. If the bond market sniffs out, that it thinks the economy is weakening enough that looking out 6 months from now, the Fed is going to have to start lowering interest rates, then those longer term points along the maturity curve start discounting that, pretty quickly.
Yeah. So the summary there is, as I said at the beginning, and I'm always saying, if it makes sense for your family to buy now, doing the financial plan with the wonderful people like Brenda's group, your analysis is that yes, we can buy a house, and rates go up, you'll be glad you bought, and if rates go down, you'll refinance. I mean, that's what we're predicting is that we'll see some, churning of mortgages, which again is why we're not offering them at par pricing that often with 0 points. That's the kind of the thinking there. So, well, great. Does anybody have any other questions? I think my wrap from what I got was that we're not yet in a recession. We might head into one. We don't expect it to be a tragic one. We're not heading into the Great Depression or the Great, recession of 2008-9. And seems to me that some of this might even be somewhat of a healthy check to get us back to, because it wasn't normal to have rates of 2.5%, and it wasn't normal to have a Fed funds rate of 0. So maybe
that's absolutely right.
More normalized economy.
Yeah, that's absolutely right. And even when we look at, the valuation of the stock market, it's not normal to have it above one standard deviation above the norm for 2 years running. It's just not normal. So I think that that some coming back down to earth is a good thing ultimately. But
we're not panicking and running for the hills and selling everything.
No, yes, I do not think it's the time to do that at all. In fact, when it comes to financial markets, we're seeing opportunity now that wasn't there last year. So lots more opportunity.
I'm sure the group here can talk about, because there are houses that you wouldn't have bought for the prices that are out there now, even a few months back. So opportunity is knocking. Well, Brenda, thank you so much. I would like to remind everybody, I see Eric, you have one more question. Go ahead.
I have a question, actually, if you don't mind, Nikki.
Yeah.
Brenda, thank you so much for this. It's very informative. It's fun to see the different ways things are looked at. And I love that chart about the commodities prices actually coming down, yet inflation, there's the lag between what the companies are saying, well, let's just keep charging them. We can argue that one way or the other, or are they just saying, okay, well, we need to catch up because, all these prices, for goods and services, we're not going to adjust them that quickly, just in case. But my question is in regards to something I don't think I heard in regards to the strength of the dollar, and the value has gone up a lot, more than I've ever seen against European currencies, especially now the British pound. That one almost shocked me, because that used to be, I always think of it backwards for most people, but I think, a dollar gets me 70 cents in the UK, and now it's getting me almost parity. How does that affect? I know it affects multinational corporations when they're, bringing their dollar back, but how in general does the dollar strength affect our economy?
Yeah, I mean, in general, it's funny because I have a lot of clients that always think when the dollar is not strongly valued, that's a bad thing. It's really not. When it comes to the economy, it's more beneficial to have a dollar that isn't strong relative to other currencies, because again, it makes our goods and services more expensive. It's good for imported goods for us because it makes them all less expensive. And so from a consumer standpoint, it's a positive in that sense, is that it actually should be deflationary for us, because it should mean that prices are lower for imported goods. But it does, again, mean that on a global scale, it's in some ways, it's good and bad for commodities. This is the other thing. Most commodities globally are traded in dollars. So if you think about the increase that's happened with our currency and where commodity prices were 6 months ago, it was kind of this horrible scenario for any foreign entity that was buying commodities. But we've since seen that commodity prices come down a little bit. I absolutely think some of that has to do with the strength of the dollar, because it causes, in some cases, a demand to start waning when prices are that expensive for foreign buyers. So we could start to see a strong dollar contribute to some deflation with prices, especially on the imported side. But generally speaking, from an economic standpoint, it's not really a good thing because, again, it makes all of our goods and services more expensive in the global marketplace.
Well, we just need to go buy homes in France, that way, when it comes back the other way, I've secured my dollars against the euro, so.
We have actually, just this week, we had 2 different clients asking about buying property internationally and whether they should start buying some of the currency that they wanted to transact their homes in. So interesting prospect that I think people are taking advantage in some cases of the strong dollar and looking internationally for that home in Portugal or wherever it might be.
Crossed my mind.
Yeah.
A house next month.
Yeah.
Brenda, thank you again. And I would just like to remind everybody, your clients would be so well taken care of at Untitled Global Advisors. They are the best of the best. I love referring them, and they're just an amazing group run by some amazing people and lots of good women. So love it. And thank you for joining us.
My pleasure. Thank you, Nikki. And thank you all for your great questions.
With Brenda all sorts of ways, but if you don't have her contact information, don't hesitate to reach out to me.
Great. All right. Thank you, everybody.
All right. Thanks.